Welcome to the Aramir Roundtable. Just before we get started, a disclosure that Aramir is not a broker-dealer or investment advisor. This presentation is for educational purposes only. We're not making any specific trade recommendations. We don't know your situation and have no way of knowing what level of risk is appropriate for you. The risk of loss in trading options can be substantial, so please be aware of all your risks prior to placing any trades. Past performance is not indicative of future results. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So I forgot to introduce Bruno. Bruno and I have known each other for what, 15 years or more? It's been a long time.
We're going on nearly 20, yeah.
Yeah. So it's always a pleasure to have Bruno back. If you don't know Bruno, you should get to know him because he's very smart and very knowledgeable, and I'm sure we'll enjoy this presentation on the Rhino. But with that, I guess I'll stop sharing my screen so you can share yours, and we can keep going here. Oh, there it is.
There it is. How do I start slideshow? Yeah. So I should have it full screen now.
Yep, it is. And I'll mute myself just in case there's any background noises we don't want to hear.
Okay. Right, so let's talk about the Rhino trade. This is nothing really new. I mean, it's been around for maybe 3-4 years. And there has been some presentations. Some of them are public. So a lot of knowledge is already available either on CD or now Aramir or even on YouTube. So it's just going to be an update. So we're going to review a few things and maybe look at what has evolved in the last year or so, 2 years in this bullish market, and also see how the trade has evolved from Brian Larson's, the original designer, his original design, and maybe also how he has actually made his trade strategy evolve over time. So I start with a qui suis-je en français, in French, yeah, because let's not forget I'm French, so please excuse my English. Although I've lived about 30 years in South Africa, so my English shouldn't be too bad. So yeah, I've worked in finance basically all my life, and as Tom said, I'm a bit of a math guy, you know, working on I worked on my own. So basically, I followed my own route, my own path, and and I chose to work more into pattern matching, artificial intelligence, which I've applied on a variety of asset classes, forex, ETFs, basically almost everything except for stock picking, individual stocks, and bonds. So in this presentation, as in the previous ones, I'd like to also to point out that a strategy is always adapted to the designer or the user, or in my own case, the mentor. And the fact is that my trading style, my risk profile may not affect, but it will change the way I trade the Rhino. The Rhino is like the M3 from John Locke, you know, talks more about guidelines than fixed rules. And here as well, we're going to talk about guidelines, concepts, and there's some flexibility in the way you apply them. So we're going to start with a short recap, definition of a Rhino. I believe the trading discipline is very important. It's also the way I approach a strategy that could be actually applicable to any strategy. The daily management, maybe because mine differs a little from the way Brian approached the Rhino, and we're going to see some variations. So the Rhino is basically hedged butterfly, in this case a broken wing butterfly. I know that a lot of traders tend to stick to a family. There are condor traders, there are butterfly traders, and I remember someone talking about condors like a split strike butterfly. I mean, It's really the way you. So what I'm trying to say is that it's important to know and improve, learn more on a specific family of strategies. And then we can say, I mean, I can say, because I've got sufficient experience, that, okay, a broken butterfly is a broken butterfly is a broken butterfly. And so I could go just to the very general concept, but and I hope you will send me questions to just point out and express the differences. But I believe that, for me, that if you know how to trade a broken butterfly, you can trade any strategy in that family. So the Rhino is typically an OTM put broken butterfly, just placed positioned slightly out of the money, with the upper longs at or just a little bit under the ATM strike, and that will constitute the main horn. When in previous presentations we talked about the Rhino, about it like a two-horn strategy. Yes, the thing is that we tend to use a second horn in the form of an upside hedge, even though for a broken butterfly the upside shows less risk. I mean, you have at the start, at inception, a lower upside risk, but you still have to hedge it. It is, I mean, normally one shouldn't lose money on the upside, and the Rhino is naturally resilient on the downside. But generally, we can see that there's actually more work on the upside. The downside is actually fairly easy to look after. We're going to see that we typically use call calendars on the upside. Some people prefer to use an upside hedge in the form of a call broken butterfly. And recently, I've actually used that more often than the call calendars, because last year, October, November, in a very low IV environment, even though a call calendar is supposed to be dealt a Vega positive, it doesn't always work that way. And also, some people are less comfortable with horizontal spreads, and I can understand that. So again, flexibility, you can choose the type of upside hedge you're comfortable with. It is, I mean, it is a very conservative trade. Maybe not as conservative as the RTT, although I would say the RTT is, in its concept, more forgiving on the upside, but could be more work on the downside. So this one is probably just as conservative, with less work on the downside and a little bit more work on the upside. What maybe makes it very different from a lot of other strategies is that, and I can, for example, compare it to the Kevlar, is that the strategy itself has very low delta alerts. It's a very flat delta, no gamma type of strategy. And the earlier you start and earlier you exit your strategy, you will have no gamma issue whatsoever. It is also quite easy to manage. We're going to talk later that in terms of management, you can monitor it once or twice a day. I recommend twice a day, but it doesn't take too much time to trade this strategy. And I would say 95% of adjustments, the timing is not essential. I can see from my subscribers that a lot of people just apply the adjustment sometimes a few hours later. I tend to, because I live in Europe at the moment, I tend to do my adjustments more in the morning than the evening. But a lot of people who have a day job and they want to adjust it later in the day in the US, that's not a problem. So it is quite versatile, and of course it's a matter of controlling how versatile one wants it to be, and it's quite simple. I advise people who start with the Rhino to use the strict guidelines, the strict delta alerts, even though they may be a price to pay. If you have, even though it's a very conservative with already low delta alerts, if you really stick to those delta alerts and it goes against your feel for the market, I mean, I can understand that sometimes you want to adjust a bit earlier, just in terms of, and just for the sake of having your P&L fluctuate a bit less. It can, I mean, for example, a brokering bearish butterfly type of trade can have large fluctuations in terms of your P&L. A rhino is less so. That's why I'm saying it's conservative. You don't have those wide variations in terms of profit and loss, but you can even adjust it to your trading style and make it later, make your alerts more suitable, more convenient with your trading style and profile. But as I said, when you learn into the trade, it's better to stick to the guidelines and then adjust the alert levels to what you feel is right for you. I could make almost a bit of a joke in terms of flexibility and versatility, because I'd like to take it as, I mean, it will become, at least in my group, it is slowly becoming a more and more generic type of brokering butterfly trading, and that you then adapt to your own trading style. So can we then use different setups and different adjustments using all the tools available? Eventually it could be. The Rhino could be almost like a generic name for brokering butterfly trading. But of course, I understand that people have different experience and knowledge about the Greeks, about butterfly trading. So we start with a standard set of tools. But in my group, I have actually taught people to use new adjustments that were not part of the rhinos initially, or like I've done because I thought it would be more suitable in a very bullish market to start mixing it with the RTT. So work on a kind of an RTT mutation. So what I'm saying is that the more comfortable you are, I mean, the longer you stay with the trade, the more you adjust the rules to your own profile, but also you start using more tools to adjust it the way you want. So maybe it's a very ambitious kind of objective, but I believe it's possible. So let's have a look, for those who are still new with the trade, let's have a look at a typical setup. This is a September trade. I mean, this screenshot was taken when I wrote this presentation last week. So it's a very typical RUT entry. We place I don't know whether you can see my cursor.
Yeah, we can see it.
Okay. So we place roughly the upper longs 10, 20 points, about 1%, sometimes 0.5% above the market. So you can see it starts, again, more important than the tools and the setups. It's what I look at is really, are we starting with a very flat delta? In this case, even though in a bullish market, we can have more skew and more negative delta. This is actually a very good type of setup. We start with only 5 delta for 5 brokering butterflies. This is a standard initial tranche for the Rhino. You can see that unless we have a very abrupt, sharp fall, this curve should actually stay flat. I mean, in any case, if we start early, as we're going to see, the trade is very, very resilient, very solid on the downside in the first 2 to 3 weeks. So there's nothing to worry about an entry. There's hardly ever a second thought about entering a trade. So this is a trade that is quite resilient on the downside. And as you can see, initially it has limited upside risk. And as we're going to see, we have a variety of edges for that matter. So just, I'm going to go quick on this one because there have been some presentations. So this, for the Russell, we enter 5, 50, 40, put broken butterflies, upper longs, half, 1/2 to 1% above the money. We can use wider wings, 60, 50, 70, 50. As long as you stay within a similar ratio, the rules will remain the same. Preferably early. If you start around 70 T, you'll have a very calm start, kickoff, flat T plus 0. Of course, the earlier you start, the more capital you will have to engage, because you have to take care of other trades that are still in. Like, of course, you have the previous cycle that will be 28, so about 49 days to expiration, and maybe even a third one towards the end of its life. The importance of starting early is that what is something that we call cognitive dissonance in marketing. That, for example, when you go for an impulse buy, excuse me, and the next day or the next week you say, oops, I shouldn't have done so. There's hardly ever that feeling with a rhino. There's no, I shouldn't have done so. I mean, the trade usually, I wouldn't call it an RTT, but it's a trade that usually in the first 2 to 3 weeks, you just check it, there's nothing to do. So even though you may have 2 or 3 cycles on, 3 is a bit too much for the rhino, but let's say 2 cycles, the one that is in its growth phase needs very little attention. In low IV, you will try and enter early because you get a better price. But if you want to enter it later because you want to reduce or eliminate that overlaps between trades, that's also possible, but you will have more chance of having to adjust quicker, because if you enter later, you're going to pay more, and there's a big chance that you will have already a more negative delta at inception. So that means that if you start with a 20, 25 delta, I'm just saying from the top of my head, at day one, and knowing the alerts, I mean, we're going to look at alert levels now. It means that you will have to forfeit that peace of mind that you would have if you had started earlier. Like most of those trades, a down day, vol pop, because of course you will get a better premium for your shorts. So a down day is always preferable. For the SPX, I stay within the same ratio. 3 setups are possible: 80-60, 100/75, or even a 75-50. They are all in the same wing size ratio. Same type of setup. That's what makes it easy to port to to transfer onto a new underlying, a new symbol. Is that it's about the same strategy regardless of the underlying symbol. Earlier, before we started this presentation, Tom mentioned that I'm very I'm a math type of guy, and I enjoy the modeling and the theory of options trading, volt surface, etc. I would say yes. It's better to have this applied on indices. I haven't tried it on the NDX. I know on the previous presentation, people asked me that, well, would you do it on Forex? Would you do it on Comos? I haven't done so, and I believe the volt smile is very different. So even though I think it's for indices and European options with similar volt surface, it can be applicable easily. I'm going to try later, maybe later this year or earlier next year, to trade the Rhino on DAX options. Here in Europe, but I wouldn't go now. At least not until I have my own modeling tool. I wouldn't go as far as porting it to single stock options, even the FANGs or American options in general. I think when you know your field, you should stick to it and move very carefully if you want to apply it. Some people say, well, it's just a a delta-based strategy, just monitor your delta, and that's it. I mean, you can work on anything. It may work, but I would not myself be comfortable just trading this strategy before I study it very, very thoroughly on other underlines. One thing we need to remind ourselves is that larger wings means more capital, but also means larger skew. So in the last 2 years, I have traded Rhino mostly on SPX on 100/75 wings. And if the market had, I mean, we can't predict the market. The market has gone up and up and up. And of course, you expect at some point it will abate, stall, I mean, stay within the range. So if you have a larger skew, it's a give and take. A larger skew gives you more negative delta, and more negative delta gives you more resilience on the downside. So the trade is more solid on the downside. So this larger skew using a larger wing Rhino has been a little bit detrimental to the strategy in a very bullish market. So I would say if we expect the trade to keep going up for the later part of this year or even next year, I would say, and maybe in hindsight, I should have used narrower wings. But besides that, I mean, it's not a major difference. It just makes you work a bit harder on the upside. So scaling in, that's pretty simple. I'm just giving the example for the Russell. You just add another batch of 5 put broken butterflies. Generally, when I mean, it's just to extend the tent on the upside. So when the underlying leaves the tent on the upside, you just cover it with another batch of broken butterflies. You place them about 20 points above the initial ones. You can go as far as pushing it further, I mean, higher, just to remain inside the tent. But the original strategy said that you would only go 20 points, even if the SPX or the RUT is outside the tent. One reason is that you can expect the market to retrace, and also that if the market goes up, and usually the volatility goes down, your second batch of broken butterfly will be more expensive. So if the market goes, let's say, up 35 points, and you stick to a 20-point rule to place your second batch, they will be cheaper. So you will not add as much negative delta, and you will have a lower risk on the upside. Again, I was talking earlier about flexibility. Would you like to have more theta and cover the current price? It's up to you, but I would say it's part of the original rules, and I would agree with that. That, I mean, we want, when the market goes up, to still pay a reasonable price for our broken butterfly. Something I've added from the original Rhino, and I don't think Brian has actually changed that in his updated rules, is that I want to use the capital more efficiently. As I said in one previous slide, is that it's also a matter of adding more branches in this decision tree. I mean, why not scaling in if the market goes down? I mean, you can of course start applying PDS, or you can roll back. But if you have enough capital, I also now allow to add that second batch of broken butterflies also on the downside. So basically, whether the market goes up or down, by 56 DT, I try and be at full position. One reason to go to add also on the downside is that, as we're going to see now, the trade will perform better, a lot better, in between the horns, assuming there's a second horn, like already an upside hedge. So if the market starts going down and passes the shorts, I take that as a warning. So if I've got spare capital, it's early in the trade is quite resilient initially, why not just adding capital and adding a lower batch of brokering butterflies to flatten delta and extend the trend to the downside? I mean, to me, it just made sense. So I would say that the Rhino is quite safe. I start with a brokering butterfly, etc. So, yeah, I mean, the devil is in the details, so to say. So this Rhino may be slightly different from Brian's Rhino. I remember Jim Riggio saying, oh, well, you're copying from the Kevlar. I would say if you have a lot of experience trading this type of strategy, butterflies in general, or brokering butterflies, yes, there are a lot of similarities. And I would say what makes it really different from the rest is it remains, in all events, a safe trade. Capital preservation is the most important rule. And from what I've seen, and there are lots of strategies on the market, it's probably the one that keeps the delta the flatter, and also low gamma. So as I said, the rules and guidelines are similar or the same for as long as you keep a same wing size ratio. Because if you start playing with wing size ratio, I mean, you can say, well, a balanced butterfly is a brokering butterfly that is not so broken. No, I mean, if you trade a standard butterfly, the rules would be different. So I'm talking about the ratio upwing to downwing, PDS to PCS, around 0.75 to 0.8. I wouldn't go as far as 1, like that would be a balanced butterfly. No, I'm talking for this type of rules and guidelines for brokering butterflies that are in this type of ratio. The management is quite easy. I don't want people to think that they have to monitor the market all day long. Actually, it would be a very bad idea, because it's the best recipe to start over-adjusting, overthinking. No, you should stick to a discipline, and the discipline is that you do your homework. You check, for example, for what are the news. Like I checked on Econodate this morning, and there's nothing happening except for the Fed 2 p.m. I mean, you have to prepare, have your plan for the day, and then you have a quick check after the open, and maybe preferably also in the afternoon. If you don't have time for 2 checks a day, you just do 1. But still, I believe even though it may be a part-time job or an occupation on the side, it's quite important to have the discipline of a professional trader. So the typical adjustments, as I said earlier, it could be anything under the sun, but no. Generally, we're going to cut delta by half by adding on the upside an OTM call calendar, generally placed somewhat higher to provide some delta lift. If you place your call calendar too close to the money, it may have a bit of a Vega relief, but it will not raise your delta. So I would say it has to be 1 to 2% above the money. Alternatively, you can sell put verticals or condors if you are tight on capital. Basically, it's a short condor where it's a vertical, but you also push your lower longs a little so that your capital usage it remains stable. On the upside, we can, instead of the call calendars, just add a smaller size put brokering butterfly. Let's say you have 3, 4, 5 regular size brokering butterfly. You can have a smaller one, maybe 75-50 or 50-25, or sometimes if you want to catch more premium. I mean, you adjust the size of the breaking the butterfly on the upside to your capital requirements. But generally, yes, you can have a little put butterfly on the upside. In the original guidelines, we say that, I mean, Brian said you should substitute the calendars for a call breaking butterfly. I'm not saying he's wrong. Why not? But generally, I would rather stay on the put side. I mean, it makes also the skew analysis easier if you don't mix puts and calls. So, and what I've done quite often in the last year and a half is just to not to have to think too much. I mean, chase the market, keep adjusting, keep adjusting. You just take off your upside hedge and you start applying reverse RV. So basically, your trade becomes more of an RTT. On the downside, same rule. You cut your positive delta by half. So you start by removing whatever you had put on the upside. So you scale back to, if you had a full size, you scale back, for example, to half size, basically your original entry setup. And then you may just start scaling back, rolling back your, if necessary, if the trade. But as I said, the trade generally has good resilience. So it's quite solid on the downside. So that's, I mean, I hardly ever roll back, but it may happen. Yeah. Delta limit, as I said, on the upside, it was -5 per broken butterfly. I use a number per broken butterfly because also in terms of sizes, it could be 5 + 5. But if, for example, and that's something that Brian tends to ignore, I mean, we have to work within a certain planned capital, a certain amount of money. So sometimes if you have more than 2, so let's say 3, because you have entered your 77 GTE new entry, and you have the one at 48 and maybe one that is near the end and you're struggling with it and you haven't exited it. So you may be tight on capital. So sometimes you have less than original size. So instead of 10, you have actually downscaled to 8 or 7. So you adjust your delta limit by just applying that rule per broken butterfly you have in the market. And on the downside, the maximum delta is 25 for the Russell. We're going to see that actually we tend to use less on the SPX. And realistically, I mean, personally, that I said that the trade is to be customized to your own trading profile. Personally, I actually start adjusting as soon as the market is passing the lower shorts, and I mean, and 25 is I mean, I will start adjusting if we are at 15, 20. 25 is the maximum, is the limit. I mean, you definitely have to do something at delta 25. Oops. Are you still seeing something?
Yeah.
Okay.
Looks like PowerPoint crashed.
Okay. I hope it's coming back. I don't know. First time I see that. Sorry about this. Where was I? I hope. Maybe it's a good time to take a few questions. Are there questions, Tom?
Oh yeah, sorry, I muted myself. Yeah, Jed asked if you could expand on the term larger skew. I think that was before your scaling in slide, maybe slide 9.
Okay. The skew, I mean, it's a very interesting topic, but just to make it simple, the skew, I mean, if you had no skew, you would have your T + 0, T + N more or less always showing a top maximum near the shorts. The skew is something that actually turns your trade. I mean, this, as I said earlier, the skew is actually something nice to have if the market turns lower. Oh no, okay. I'm a bit worried it's going to crash again. The skew is because people tend to hedge more with puts. Oh no, oh no, no. I don't know what's wrong. It's crashing again. You'll have to edit, or I'll do it for you. Edit the recording to cut those. I don't know why.
Yeah, I haven't seen it crash like that.
No, it's the first time I see that. Maybe I will just go slide by slide like this. Okay, so the skew comes from differences in the way the puts and the calls are traded according to strikes. Basically, the different IV per strike causes the skew. In the original Black and Scholl formula, where it was assumed that the volatility is constant across the whole options chain, which of course isn't true, there wouldn't be any skew. So it comes from the varying volatility going higher and higher as your strikes go lower. And of course, that skew itself changes over time. So, but I think I should try eventually to make, I mean, it will be part of the description of my modeling. So I will do another roundtable on modeling, and I will explain the skew in more detail. So because if I get started on this, I'm going to spend an hour or two on this.
Yeah, I'm sure you could go pretty deep.
Yes, and I'm going to lose many people.
There were a couple more questions. Mary Ellen asked, existing call calendars are replaced by broken wing butterflies after 35 to 28 DTE, question mark, just want to confirm.
Yes, that was part of the original rules. I don't always agree with that. I've seen call calendars actually behaving pretty well after 21 or 14 DTE. The question, in my view, is that if you don't have a lot of experience in trading or horizontal spreads, it may be easier to change it for brokering butterflies, either on the put or call side. So maybe I can understand that it may be more difficult to trade, but I don't think so. So, and recently I've actually used more brokering butterflies and call calendars. And yes, they're more peaceful. They're more peaceful, but there's nothing wrong with using call calendars. For people who are comfortable with trading them, there's no problem with trading them late in the trade. I know, again, you know, I said in the first slide that a strategy reflects the designer's comfortability and experience with this or that in terms of setups and adjustments. I don't have a problem with call calendars, but some people may. And Brian probably has also some difficulties dealing with calendars late in the trade. So it's a personal preference, but I don't think there's any theoretical reason not to use call calendars late in the trade. So in terms of, are there any other questions, or should I carry on?
Well, two more, but maybe we can hold them to the end.
Okay. So I'm going to quickly on the exit rules. Usually, if you get your profit target, maybe that's something that makes it different from other strategies. Is that if you make your money early, you exit. I mean, some people even use a repo variation to the trade. That's also possible. It's more difficult to test, but some people say they make $1,000 or 1,500 and they just close, and then they reposition. They reposition using maybe the month-end expirations, or they choose something between, as I said earlier, 56 to 84 DTE. Basically, they move on smaller profit targets. It's also a possibility, but generally, if you make your money early because the market hasn't moved much, you exit at 10% on PC planned capital about 35 DTE, and then you reduce your profit target. I think it's a safe way to preserve your profit, especially if the market, I mean, the trade is easier to trade, is a lot easier early. I mean, in the growth phase, 77 to 56 days, nothing really happens unless there's a very major market move. It's easy to trade. The trade becomes, I mean, in its mature stage, the trade is still easy to trade. The dynamics change a little, but for people who are less comfortable dealing with the later part after 35 or 28 DTE, it's maybe easier just to take a smaller profit target and exit and move on. So that's what also makes it easy. So that's also a reason for exiting early and not wait for a higher profit. Something that makes this Rhino different from the original Rhino is that Brian never used any market view. He wanted a trade that was quasi-mechanical. I think it's a bit of a myth, but that's what he wanted. So basically, I chose to have I have this daily chart that I use and I make available to the subscribers. As you can see, I used to be more of a directional trader. As you can see, the signals are fairly accurate, like a short here, a long here. Now it's turning, I mean, it's been a bit confused here, but now it's turning short. It turned short actually near the top when we were 28.50 or something. So in any case, if you do your game plan in the morning, you follow the market, you always have a bias or some anticipation of the market. So I'm not saying that you're going to bias your trade, but in any case, it will probably help you time your entry more accurately, because you can maybe think like now we are at 80 something days to expiration for October. So it's time to start thinking about the October entry. So if you have some anticipation, the market may retrace, vol may pop up. So I think it's a bit, I mean, it's a kind of a denial not to say that you never have a market view. Let's accept that you have one. It could be right or wrong, but you have one. So I chose to have one. And also, I think the old-timers, options traders in the 80s and 90s used to really have the Greeks type of dashboard and live in a bubble, not looking at anything else. I think that time is long gone. I mean, the market, not only the markets have changed, but we have to accept that the market outlook, the market environment can have an impact on your strategy. So the daily routine, I'm going to go fast because I've already mentioned that. I mean, I check the futures markets in the morning, economic news on Econo Day. Sometimes also I check whether there have been any tweets flying around. The vol regime, that's something that has been important in the last year, and maybe even more so this year, because the volatility has been a bit weird since the mini crash in February. So you can choose to manage your trade once or twice a day. I recommend twice a day, but I can understand some people don't have the time. Once a day is good enough. So, and if you can do it twice, I would say 10 a.m., so just after the open and maybe in the last half trading. So I see that I'm only halfway through the presentation and we are 3/4 of an hour. Yeah. Can we adapt the alert levels? Yes. As I kind of hinted earlier, you can choose to have lower alert levels, but I would say that you have to be careful not to fall into the trap of over adjusting. So as market neutral traders, we play theta. And so it's also, if you have larger alert levels, like I said, -5, for example, on the upside for per broken butterfly. If you say, well, I believe the market is going to retrace, going to profit taking, whatever, I'm prepared to go for -7, -8. Why not? I mean, but you may accept that you may have a far more volatility in your profit and losses. So if you are more conservative, like I've been in the last 2 years, your average returns will be slightly lower than what is shown earlier with the profit targets. I think it is realistic to make 20, 25. In the market we've had, it's realistic to make 20, 25% per year, even though if you can really stick to the Delta guidelines, you may make more, but when you lose, you will also lose a bit more. So it's always the risk-reward type of trade-off. Nothing really new here. The optimal range for the strategy is in between the horns. So if you are in between the horns, yes, you can maybe that's where you're going to have the more theta. So you can be a little bit more. You can relax the alert levels, but be more careful outside the tent. Actually in the strategy itself, we reduce the delta alert outside the tent. So I think I'm going to, that's end of part one.
We could have a part two if you want to, but there were a couple more questions.
Okay.
Wayne asked, how about hedging the downside with VIX calls near term?
Can you repeat?
He asked about hedging the downside with VIX calls near term, like close to expiration.
I have not done that, but something I've done in the last 2 years is I have added a Vega hedge in the form of a put calendar, and that has worked very, very well. That's if you. I mean, I don't really hedge with short futures or anything really outside the strategy. But so maybe I went a bit too far, but in saying that you can use anything under the sun. No, I'm just saying that you can extend your tool set, your toolbox with put calendars or having a bearish hedge with a far OTM broken butterfly. There are various ways to hedge on the downside. And I would say the most common one is to use a put calendar. So I've used that on several occasions in the last 2 years. Yeah.
Okay, and then Otmar asked, planned capital of 25K means how many rhinos?
That's one rhino. That's one rhino in one cycle.
Okay, and then the account size that you're using?
I mean, capital has been sometimes a little bit tight in the last 2 years, especially because in low IV, we had to keep the trades longer. And we had sometimes 3 cycles on. So that's also a reason why I'm not too strict on the position size. I mean, I said tranche is 5 broken butterfly for the Russell and 3 for the SPX. On a number of occasions, I have entered a lower entry. I said, well, I'm not too sure about the market. Instead of 3, I'm going to enter 2 broken butterfly on the SPX. It can be a personal choice, or it can be dictated by capital. I have actually chosen to stick with the original rules from Brian, even though he himself has chosen not to follow his own rule. But because Brian suggests we use 25K per cycle, and if you use overlapping or any additional capital for new cycles, that's your problem. The guideline says you have 1.5 rhino available. So, and in most cases that's all right, because if you have only 2 cycles on, and you have your 1 rhino at full size that uses up to $25,000, and the new rhino has only the first tranche, so it's probably about half size. So by and large, 1.5 times 25, so 37.5 is enough for a full tranche of rhinos, allowing for reasonable overlapping. That said, in low IV, it sometimes has been a bit tight. That's why the position size has sometimes been lower.
Okay, and Amar also asked, can TOS be used? I'm sure it can.
Oh, yeah. I use OV, but TOS or one generally have, in terms of modeling, the delta is slightly, if delta is negative, it's going to be flatter on TOS or one. So basically, if the market tends to tank, you may reach a positive delta alert quicker. So yes, I don't think there's any major difference in terms of management. As I said, you can actually change the alert levels to your own convenience, your own trading style, risk profile. So by and large, there's no major difference. No.
Okay, then another question. How do you handle the Rhino if the market stalls in between the horns close to expiration, low theta, potential sink in the sea of death?
That has never been an issue. If there's a potential sea of death, I will close my upside hedge and or close the entire trade. But I don't. Unlike the Brian's Rhino, I never let theta go negative. So it's never ever been an issue. So let's talk about the trade evolution. We have a little time, so maybe we'll have another round table. But there are differences between Brian's Rhino and my Rhino, and one difference is that Brian tends to trade the hedge very actively. So let's say you have a call calendar and the market keeps pushing, he will start rolling or adding calendars. Some people are not comfortable with the calendars, and also I think if you learn a trade, learning the brokering butterfly, especially the put brokering butterfly, becomes second nature. So I think if you start trading the hedge very actively, you get into a new strategy, another type of strategy. So I think, in my view, there's a limit to trading the upside hedge. But that said, if your upside hedge is also a put brokering butterfly, it is just an extension of your initial combos. So I would say, generally, I don't really trade the hedge. I've chosen on several occasions just you take the trade into RTT and not be bothered about the upside. And of course, the flip side of the coin is that you make less money, but at least you have no upside risk. That's what I've done. We don't really have the time. Maybe if there's another slot available, I'd be happy to carry on with the part two, with which will be specifically on differences between my Rhino and Brian's Rhino. Maybe because I think we are now at 54 minutes, so 1 hour we should be closing soon. But I can maybe show you if that works.
Yeah, we can come up with a part two date. That's not a problem.
Okay, maybe let's do that. Wait. Let's
Dan and I were scheduled for next week, but I'm still putting the presentation together, so I could slip mine, and if you want to slip into next week and to do a part two. That
would be good, yeah.
Okay.
Let's just have a look at the current trades. For example, I have here the September trade. The September trade, I mean, it's actually a good example. What I've done here is I started when the market was lower with a first batch of a brokering butterfly. And the market started pushing. What I did, and it's actually easier to see on the matrix, the first batch was actually 2, not 3, because I was a bit uncertain about the market. I started with brokering butterflies of the size 100/75, 2625, 2725, 2800. When the market started pushing, I applied the rule, but then what did I choose? Do I choose to stick to another batch of same size brokering butterfly, or is the market going to aim straight back at January highs? I do have enough downside cover. My first batch of brokering butterflies is doing its job. So what I chose is, no, I'm going to do more an RTT style on the second half. So I chose to have a 2675, 2775, 28.25. So 100 slice 50 with the upper longs right on the money. So not only I flattened the delta, because if I had gone on low IV, check this IV, it's very low. If I had gone for a regular size broken butterfly, I would have paid a lot more, and I would have fed a lot of negative delta. So the prevailing rule is to keep your delta flat. You have a manageable trade. So by doing that, I have only minus 11. So I basically have about 3 delta per broken butterfly. So very easy trade to manage. So that shows the flexibility in this type of management. Now, not only I've got I have a maximum of 1,400. So my maximum loss is about $350 per broken butterfly. And I don't have to worry too much. I don't, beside that scaling in, I haven't done anything to this trade. So just an example where you can mix with RTT. So you can, sometimes the market is just shooting off and you want to start straight with an RTT type of entry, but generally it's going to be as you scale in. Basically, it's exactly the same as if I had chosen to enter a regular size broken butterfly on the upside, but to flatten delta, because delta would be too high, I apply straight away a PCS. And in this case, the PCS would be a kind of a reverse Harvey, just pulling back the upper longs. So this is typically what you can do, because again, what's most important is to keep your delta flat. Now let's have a look quickly at the August trade. Late in the trade, I mean, I could have actually closed it. Where's my August trade? There it is. I'm going to show you the extended one, which is the variant I generally keep later into the trade. There again, for me, it's also because of this summer trading. Summer trading can be quite treacherous. I had an upside hedge somewhere here, and I decided, okay, the market it keeps going up. I'm not going to do what Brian would do, chase the market, roll my upside hedge. No, I said no. I made a bit of money on my upside hedge, very good. And I started doing reverse Harvey. So now the market can do whatever. I secure about 3% on planned capital. Now, why am I not closing it since I'm pretty close to the upper expression line? Well, I'm still hoping if the market retraces, I may benefit from this little hump near expiration. That's the only reason why I'm keeping this trade on. And I can then, I mean, people can be on holiday or they can have a day job. Personally, I spend my days coding and studying vault surface stuff, etc. Basically, it's a no-brainer. I don't want to spend too much time thinking about those trades. My September trade doesn't need much attention, and my August trade I can even leave to expiration. I generally keep my trade to expiration if I've got about 3 SD. So I don't have really 3 SD. I've got about 2 SD. So I will probably close this trade probably about 7:10 DT, unless the volatility drops further. So I'm still very conservative. You know, 2 SD is not good enough. I mean, I've seen some people getting hurt by keeping a trade to expiration, and the market on settlement day at the open had lost about 40 points. I mean, sometimes you think it's a winner, and you can be, so you have to be careful. This trade has got no gamma, no delta. It's fine, but still, in terms of probability, you have to be careful. Okay, I think we're down to 1 hour, so maybe just take a few questions if you spot, and then we will schedule a second presentation.
Well, actually, I think that's it for the questions. So I actually was wrong. I had another event scheduled on the 8th next week, but the 9th is free. So if you want to do part 2 on Thursday at the same time, that would be great.
I can do anytime. I'm working flat out at the moment, so no holidays for me.
Okay, so let's reschedule or schedule part 2 for Thursday next week at same time.
Okay, perfect. I'm sorry I've been so long talking about. I know I never stick to 1 hour.
Oh, that's fine.
Yeah.
Oh, and then Mary Ellen asks, I see you use SPX versus RUT in your trades. Comments?
Well, that's something. I mean, in part two, I'm going to talk more about the differences, and I'm going to also do some self-criticism. As I said earlier, I should or I could have reduced the wing size because the largest queue has not been to my benefit. So the Russell naturally has less skew than the SPX. So at very least, I should have turned to a smaller size Rhino, like 8060. And the Russell was a bit wild last year, but overall, the Russell is easier to trade. So this type of SPX Rhino is fine for me, but I understand, I respect, and I think for my subscribers, I should actually, and I'm going to start probably next month, starting it on the Russell, because it's actually, I think it's an easy trade, but it's actually an easier trade on the Russell. So if it has been not a deterrent, but something that actually stop people from trading the Rhino, I think it would be a good thing for me to add it back to the class. So, yes, I'm going to start trading on the Russell again because it is overall easier to trade. It has naturally less skew than the SPX, even the smaller size one.
And Otmar asked, would it work with ES?
Oh, yes, absolutely. It's the same. Yeah. Yes, and SPX have exactly the same dynamics. Yeah.
All right, Bruno. So why don't we wrap it up for today and call this part one, and then everyone will see you for part two a week from tomorrow on the 9th of August at 11 a.m. Eastern, so same time.
Perfect. Thank
All
you
right.
for your attention.
Yep. Thanks, everyone. Thanks, Bruno. We'll see you next week.
Thank you. Bye-bye.
All right.